Good morning. Welcome to the show. It's a bloodbath out there. Everybody's panicking. No need to panic. Everything's going to be okay. All right. I need some chapstick here. All right, let's see what we got going on today. So, everything was fine, and then everybody decided that the economy is not recovering the way it's supposed to. And probably tomorrow, the Fed's going to come out and give some kind of statement, or somebody's going to give some kind of statement, and the economy is going to be recovering like it's supposed to. And inflation is fine, and everything's just fine. And they're just going to switch the yield. So they're going to pump the yields a little bit. The plunger team is going to come in and move them off of the 1.25% that they're at on the 10-year. So just relax. It's going to be all right. All right. It's going to be all right. Guys, think about this logically. Jerome Powell has come out multiple times over the last year and said, we are going to do everything in our power to keep this market going, to keep the economy going. And we are not going to back off until said happens. They're already putting in $120 billion a month in quantitative easing. It's going to be, if they need to put more, they're going to put more. Interest rates, if we continue down this path like we're seeing right now with minus over 1% every single morning, you better believe they're going to keep rates at zero until 2024. They ain't moving them off that. If they need to come back and do more stimulus, they are going to come back and do more stimulus. Mark my words, Congress will do that. They'll have opposition, but Congress will do that. Now there's a lot of stuff we're going to get into about jobs and whatnot today. There was a great sign that I saw yesterday. I was going to the dentist and I passed a restaurant in the town next to where I live. And it said, what did it say? It said, of course we're hiring. Who isn't? There's tons of jobs out there. And if people are not going to go to get those jobs, they're going to print money to give people money. They shouldn't, I don't think, but they're going to do it anyways. So everybody just calm down. All right. It's going to be okay. All right. Let's start with jobs. I just want people to think rationally when these things happen. When we see mornings like this, yeah, it's scary, sure, whatever. But you're coming off, you were hitting all-time highs yesterday in the S&P and the NASDAQ and such. So could you do videos about relationships between the yields, inflation, and the market? Of course. I will do that for you, Michael. Let me write that down. Give me 1 second. Yields, inflation, markets. Okay, you got it. So jobless claims. New weekly jobless claims unexpectedly ticked higher last week in another sign that the labor market's choppy recovery. All right. So initial jobless claims week ending in July 3rd, 373,000 versus the expected 350,000. I'm telling you, I think we're going to keep seeing this, but I think we're going to see this for another 2 months. In September, I think that the trend is going to change, and we're going to start seeing jobs truly coming back into the market. Let's see here. Lots of workers remain on the sideline. Let's see what we got here. This has been a recession like no other, with record levels of job openings calling into question the claims of Washington's policy officials that let's see here. Question the claims of Washington policy officials that additional stimulus is needed to aid the recovery. I'm telling you guys, they're gonna if they need to do more stimulus, Daddy's gonna come to the rescue and give them more stimulus. I promise you. We are faced with and this guy makes a great point in this sentence. We are faced with two conflicting data sources. One that says millions are unemployed and still out of work from the recession, and the other saying that job openings are in the millions, record levels, which ordinarily we only see when an economy is experiencing a boom. Which one is it? Got to give us something, and you got to tell us is this inflation transitory? And what the hell does transitory mean? This right here is why I think that September you're going to start seeing numbers coming back. 26 states have opted to end federal unemployment assistance before the official early September expiration date. There's a lot of them ending it at the month of, what month is it right now? It's July. A lot of them ended it in June. Some are ending it in July. So I do think that by September, we're going to start seeing those numbers, the true jobs numbers. People are going to be coming back to work because they're forced into it. And that's that. So all of this is put together in different ways, but it's all recipe in the cake. So we just got to have everything fall in place together. So Dow futures dropped 500 points. Concerns about global economic comeback. Bond yield slide. All right. Futures contracts tied to the major U.S. stock indexes fell on Thursday out as concern about the global economic comeback from COVID-19. So I guess we have this new variant out, and we don't really have a very good talking point in the market right now. So let's throw out a good talking point in the market. Here's your news story of the day. Job losses come as Japan declared a state of emergency in Tokyo for the upcoming Olympics. They're saying that they might not have any crowds there. You have a lot of big pre-market losses. Carnival, Royal Caribbean, all the airlines, retail stores. I think that all of this is wildly dramatized. I don't really think that this is warranted, but hey. Investors rotated into safety of treasuries further on Thursday, pushing the yield on the 10-year below 1.25%, the lowest since February. Now, I don't necessarily think that people are going... We have expected returns by all of these insane bulls in the market of 17% this year. 17.1%, I think, this year. You think that they're really going to roll in treasuries that are going to yield them 1.25%? No, they're not going to be content with that. As soon as we start to see a little bit of a tick in any market, they're not going to sit with that, and frankly, their clients won't let them. Traders remain confused about the exact reasons for the rollover in yields, with many citing concerns that the best of the economic recovery is behind us. Again, we have 7 million jobs that still need to be put back to work to get to pre-pandemic levels. If people do take those jobs, and the best of the economic recovery is not behind us. Just think about it. It's very simple. Let's see. I wanted to talk about the VIX. So the VIX. Somebody asked about the VIX in the Bid and Ask Nation the other day. I used to really like the VIX, and I stopped really following the VIX in 2015. And the reason was, when you have all of these companies doing stock buybacks at the rate that they're doing them, at these overinflated prices, the VIX to me is not as relevant, and then the reason is because of the stock buybacks. They are basically controlling. It's a way of them, directly or indirectly, trying to control volatility. Not trying to control volatility, it just is controlling volatility. So be careful with what you follow on the VIX. Guys, if you don't know about the VIX, just read into a little bit. It used to be a little bit more relevant in my opinion. Now I just don't see it being as relevant because of the stock buybacks that are coming in. So let's go to the 10-year yield. This is where the it has fallen. And why don't we just pull up the yield from yesterday? Okay, so the three, and that I'm telling you guys, watch for this. They've already started talking about the flattening yield curve, when the 10-year and the 3-month get really close to each other. If we get to the point where these two curves invert, where the 10-year, it becomes this number becomes lower than this number, watch out, baby. That's when you got some real issues. But that's also when daddy's going to come to the rescue and the Fed's going to do whatever they can do. So this number is now 1.25. So it's getting there. It's dropping. It's dropped at the beginning of the month. The beginning of last month, I think we were at 1.62% on the yield curve. So, all right, where were we? We're at the 10-year. Okay, 10-year. 10-year fell on Thursday, its lowest level since February. This decline in bond yields could be signaling the inflation burst is transitory, or that the Delta variant of the coronavirus will slow growth, although 1.25% this morning seems extreme. Alternatively, this decline could reflect the Fed's balance sheet, increasing a stunning plus $4 trillion in a little more than a year to over $8 trillion. If they got to go to 12, 15, they're going to do it. I promise you. The Fed is the government. JK. Kind of. Inflation expectations have been stable, suggesting that economic forces are not the heart of the slide. Okay, short-term rates. Yeah. Okay, let's go to the next thing. Let's see what the Fed. So yesterday we had the Fed minutes, and frankly, I'm getting bored of talking about the Fed, but they're the news of the day. So, and they're the reason for this. What's happening right now. So we got to talk about it. The Federal Reserve last month felt substantial further progress in the U.S. market was generally seen as not having been met yet, but they agreed that that they should be poised to act if inflation or other risks are materialized. June 15th through 16th meeting, of course, that was the meeting that they had a couple of weeks ago, felt conditions for reducing the central bank's asset purchases, quantitative easing, which is not good, would be met somewhat earlier than anticipated. they still haven't really talked about it. It's just people saying things. So they have agreed that they want to have a patient approach to this policy. Participants generally judged that, as a matter of prudent planning, it was important to be well positioned to reduce the pace of asset purchases, if appropriate, in response to the unexpected economic developments, including faster than anticipated progress toward committee's goals or the emergence of risks that could impede the attainment for the committee's goals. I don't know. I wish they would just give some direction. Just say what you want to do. It's really not that difficult. You have two main things in focus. Tell us about interest rates. Tell us about your QE. That's all you got to do. The minutes did little to clarify when the Fed was going to begin to change its monthly bond purchases and its near zero rates that have been since 2020. So at the meeting last month, the FOMC shifted towards its post-pandemic view of the world, dropping its long-standing reference to the coronavirus as a constraint on the economy. Let's see. The start of the discussion, along with the rate projection showing higher borrowing costs as soon as 2023. They're talking about, I've heard some Fed presidents say that they want to do it in 2022. Caused investors to anticipate the Fed will move faster than expected, and they might raise their interest rates, and boo-hoo, the world's going to end. Anyways, I can't read about this anymore. All right, let's do restaurants. This is a very interesting one. I want to do restaurants. So I've said it for a long time. Restaurants, hospitality is going to be the key to recovering because we got to get them back. Restaurant workers are quitting like crazy. And they're using this JOLTS number, job statistics, the labor statistics, job openings, and labor turnover. And I guess I didn't know this, but this was made popular back in 2013 by Janet Yellen. She said that she preferred this source. I didn't know that. Let's see here. Okay. The food and service industry, one of the most upended during the pandemic. There were so many restaurants that closed, lots of hotels that closed, etc. Let's see. Quits as a percentage of total separations in the accommodation of the food and services industry hit a record high of 80% in May. This number is about 5 percentage points higher than the ratio that prevailed for much of the pre-pandemic economy, a time when economists said that we were at full employment. Overall, employment remains about 7 million jobs below the February 2020 levels. So I work in a restaurant. It's getting really bad. Yeah, there's so many restaurants out there that I can't imagine. I can't go to a restaurant without seeing, we are hiring. We'll give you incentives to come work for us. We'll give you higher wages, etc. That sign that I saw yesterday was so funny. It said, of course we are hiring. Who isn't? And that was at a pretty nice restaurant over where I live. Initiatives from the national chains, to entice new hires or retain existing talent show how acute the pressure remains on the restaurants to keep enough staff on hand to operate some resembling at full capacity. Raising wages seems to do the trick, but to be honest with you, is it really doing the trick? I don't know. It doesn't. I've seen so many big companies and small businesses raising their wages, and I don't really see it. The signs are still out there. The big takeaway from this industry level data is that competition has basically never been stiffer for staffing up. Now, this leads into the next story, where there are businesses, including Amazon, switching away from drug testing for new hires. Drug tests are no longer required for most jobs in municipal offices for Isle, Minnesota. And this is coming from a liquor store owner. The reason the town's liquor store needs just one more person so that its owner, Don Graber, can stop working double shifts on the weekend. There's a lot of things that are scaring people away from potential hires, and drug testing is one of them. Graber successfully lobbied the town to eliminate drug tests, a change that has been applied across local government employee standards because the liquor store is run by the municipal government. So now job listings are boasting no drug screening, no drug testing. Hey, fine with me. I think that all drugs should be legalized with different caveats that I'm not going to say on air. Amazon has ditched drug testing from its screening program, adding its support for the legalization of marijuana at the federal level. Now, of course, with this has to come bad. Drug test manufacturers and third-party distributors and administrators have already been rocked by the pandemic. Now, with companies saying that we're not going to drug test, especially with marijuana kits, they're going to be hit a little bit. So there's a lot of these drug testing manufacturers that are going under. So there's always, guys, in economics, there's always push and pull. It's got to be, it's not just a one-way good street. The labor market crunch isn't helping. Industries like the food industry are ditching drug tests in favor of keeping staff. If you're testing them for marijuana more than anything, you're probably going to lose a fairly significant amount of your workforce. Current federal and state laws requiring drug testing in jobs like those with commercial drivers license will keep chugging along, of course. I mean, if they got to be behind the wheel. Amazon, for example, drug tests are not completely gone. The company said it would continue to do impairment checks on the job and will test for drugs and alcohol after any incident. So let's see. Drug tests have kept good people from getting jobs for years. Yeah, that's probably true. All right. Last one before we move on. This one Paul sent to me and his brother Mikey last night. Maybe it was this morning. No, it was last night. We're looking at stocks as money pots, and that's just not the cards. So let's see here. If Warren Buffett is right that investors should be fearful when others are greedy, then we should be scared right now, really scared. Consider by how much individual investors in the United States expect their portfolios to beat inflation in the coming years. According to the 2021, I'm not going to read that. On average, they expect their portfolio to produce an inflation-adjusted return of 17.3% annualized over the next decade. That's nearly triple the U.S. stock market, long-term average, real total return of 6.1% annualized, and more than 4 times the bond market's long-term average, total return of 4.1% annualized. Given the stock market's extremely overvaluation right now, coupled with real interest rates that are negative, a far from better bet is that stocks and bonds will produce returns even lower than these numbers in the coming years. So if you look at sentiment, expected returns versus what has actually happened in the past decade, take a look at this. Expected 2014 didn't match it. 15 didn't match it. 16 didn't match it. 17 just doesn't match it. And this behavior is not new. It's because investors will be their most bullish at the top of the markets. Few of us will actually follow Buffett's advice based on FOMO, and he makes a great point here. You might think that investors' biggest fear is losing money, but many money managers over the years have told me that that's not the case. More intolerable than losing is not making as much money as everybody else, and that's why money managers can't beat the market. Another great part right here. So the survey was done. When was this done? I thought it was pretty recent. I mean, not that recent. All right. This paradox of human nature was documented in a classic study several decades ago by Sarah Solnick at the University of Vermont. They asked employees, would you be paid $50,000 a year when everybody in the organization is getting paid $25,000? Or would you be paid $100,000 a year when everybody else is being paid $200,000? Half the respondents chose the first option, even though it meant that in absolute terms, they were being paid half as much. So the point is, instead of going and making more money, you have to beat everybody else. 50,000 versus 25,000. You got to beat them. And it's the same thing in the market. Ben Graham, the father of fundamental analysis, wrote in his book, The Intelligent Investor. If you haven't read The Intelligent Investor and you're watching the show, you'll probably enjoy it. The best way to measure your investing success is not by whether you're beating the market, but whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. It's hard to do. Markets are all about emotion, guys. That's all markets are. If you can keep your emotions in check, you will do well over the long term. So, all right, we looked at the yields. If you guys want to join the Patreon, patreon.com/everythingmoney. This is our page. If you want any of our software, join the $24 level right now. This gets you into the Discord, which is awesome. 3,500 plus people. and our software. If you want to join me and do some trading, which I'm about to show you for the next 8 or 9 minutes, $68 a month gets you access to me, access to all of the software, and of course the Discord and premium Discord channels. And if you're buying any kind of real estate right now, especially in today's market, and you want to do some kind of evaluation, go over it with Paul. $10,000 will get you that. Probably worth it if you're buying a massive property. So, all right, guys, give me some stocks and we'll look at them. No reason to panic today. Everything's going to be okay. Somebody gave me a stock earlier and I just can't remember what it was. I don't know, but all right, let's take a look. I want to do what do I want to do? Let's look at Twitter. Let's see what Twitter's doing. So Twitter right now moved down a little bit. It's down, I think it's down 3% pre-market, something like that. Now, does it worry me? Nah, not really. Let's zoom in over on this chart. It would worry me if it was Twitter by itself. Right now, it's Twitter with the whole market. So look how this is the 100-day moving average is all the way down here. It's just stuck at the support line at $67. I'm not worried. There's a ton of support right in here at the $67 level. No big deal, guys. When on days like this, don't go and do a panic sell. It's just not gonna it's not gonna work out for you, especially with Daddy Fed coming to the rescue in any time he needs to do it. Apple erased its gains yesterday. Why don't we take a look at Apple after this one? All right, so EZPW sitting right at its 100-day moving average. I assume that this person wants to look at it from a long perspective. I don't like that it's... When did this thing go public? It went public... Oh, okay, you're good. July of last year. So, for sure, short right now. I'm sure this gap is going to fill. The volume is pretty rough. So, let's look at something else. How do you react on days when your trades fall in the market? I don't react. It just happens. It is what it is. It's going to be fine. And even if it's not fine, then I don't know. Here, this is from Seth. Scott's Lawn in Marysville, Ohio, sent mailers to the entire town to get workers starting at a minimum of $50,000 a year. Jeez, oh man. They're sending letters to the entire town now, just to hope that they probably get like 3 people to respond. This is crazy. All right, let's look at Apple real quick. It erased its gains yesterday. So if you're in the Bid and Ask Nation, you know what we did with Apple yesterday because of the Employed Trader series. If you're not in the Bid and Ask Nation, well, you don't know. All right. Great. It has a great move up right now. It's hitting a resistance point. And of course, we knew that this was going to be a resistance point, this $144 area. And frankly, it was, and it proved to be. So let's see. Let's just keep hanging on to see what's going to happen with Apple. Apple is going to lead the market up, and Apple has led the market up. Apple will lead the market down. Oh my goodness, what is this? Is this some kind of... Yeah, all right. I'd like to look at this pipeline more than anything. I would not... Man. I mean, maybe you're looking at it to fill that gap, but this is a rough stock. Find something else. Yeah, find something else. All right, let's look at CCL. I know we have the cruise lines getting beat up today. And guys, look at this. I always talk about these moving averages and how incredible these moving averages are and how incredibly powerful they are. Look at where CCL gapped down to today. Just right there. It literally gapped down to sit at its 200-day moving average. Is that uncanny or what? It's uncanny. It just gapped right down to sit at its 200-day moving average. So let's zoom out just a touch and see where we were. And also, let's look at this. CCL is always my favorite example of a 50% rule stock. Those of you who don't know, 50% rule. You have your high, you have your low, and then you have this massive fall, and you have all of this area over top. And this is about 50% back. So here's your 100%, here's your 0%, here's your 50% area. And all of this area on top is basically called overhang. So the stock price will move up and try to recover and boom, go back down. Move up, try to recover, back down. Move up, try to recover, and it just can't do it. And it's doing it again because this is all negative pressure. Because when the stock price gets up to this 50% area, people say, all right, I'm going to take the profits that I've made and I'm going to get out of this because there's a lot of resistance there. And that proves to be what it is. So CCL has done it again. Can't break through that resistance point. And it's about $23 a share right now. And you better believe it that I'm going to be going out and selling puts on this thing today because this is great. Yeah, this is great. So for the person that just asked me, what do I do in days like this? I look at this and I get really excited and I'm going to go sell options on it because I can actually collect a premium now, more than 4 cents to sit there for 30 days or something like that. So maybe I'll get like 5 cents now. All right. AMD, I'll do AMD, but I remember looking at AMD yesterday. Pretty whatever. And everybody's just talking about it because of the gap down. This trend is going to change. Here's your stock price this morning. Your trend is going to change. In my opinion, this will drop down like so. But the good news is you've dropped down. It's really no big deal. You're probably gonna fill this gap and move back up. You're still over all your major moving averages, so I think you should be all right here. But all right, smash the like button for me, guys, and follow me on Instagram at @TraderMo_EM. DGX. Let's see here, DGX. So DGX is trying. It's down with everything else today. Guys, today's going to be a day if you're going long in stocks or something, just relax, take it easy. Jay, have we made a video about selling puts? Yes, Paul and I have a Patreon-only live stream where he and I sat down, I think it was 90 minutes, and we just talked about selling puts and calls when you own a position. But we did a whole thing, and the people that have watched it say that it's a very good video, and they understand it now. So what did I see there? Oracle. I'll do Oracle. Everybody keeps asking about Oracle. Oh, I like Oracle. So I like that I like the sweet spot reversal. I like the good volume we have coming in over all of our moving averages. It's going to be rough for you up here around $85, but if you can break through $85, you'll do all right. The good thing is that you have, oh, wait a second. What's Oracle doing pre-market? Am I missing something? Do we have a relative strength stock? No. $85. Let's go and look here. Oh. Okay. All right. So Oracle is going to open. It's going to start up here. So if you can break through this all-time high, go for it. Somebody asked me about a day trade. I'll actually do a day trade. That sounds pretty fun. And the market's about to open in 45 seconds. ADR. So what is it? ARD? ADR? I don't have ADR. Let's try ARD. Maybe he means ARD. All right. Let me know. And if it is, then we'll do it. If it's not, then we're going to get out of here. So, guys, it's going to be okay today. Don't panic sell. Don't panic sell anything. And if you're trading stocks, trust your trend. You got to have what's going to make you guys the most successful investors and traders is to be like me and Paul, where you just don't have any emotion. One of the best traders and investors out there, as far as emotion goes, is George Soros. The people that worked with him, and that name probably triggers a lot of people. The people that worked with George Soros said that it was just unbelievable how emotionless he was. He could literally own a stock and be down tons of money or tons of percentage and realize that it's a dog and he'd just be gone. And he would just exit it and move on. When you can get to that point where you are emotionless, you are going to become a phenomenal trader / investor / a lot of things in your life. So work on emotion, guys. That's what it's all about. Let days like today be training for you that it's going to be okay. And worst case scenario, you could just join the Bid and Ask Nation and I will talk you off of a ledge and your life will be better for your emotions, at least. All right, guys, you have a great day. Patreon only live stream, 2 p.m. today with me and Paul only. Seth is in the midst of a hurricane in South Carolina. That's it. Have a good one, guys. Peace.
Thank you.